Let's talk about investor sentiment right now. And I know one day doesn't necessarily constitute a change in that sentiment, but I am curious about how you feel about record levels right now for stocks and the idea here that we're heading into an earnings season where there are a lot of concerns about the pace of earnings growth.
Well, we do believe that investors had gotten ahead of themselves. Certainly, as you know, there's a lot of uncertainty out there, uncertainty about the trajectory of the economy. And while we do forecast a soft landing, there's still a lot of bumps along the road. Concerns about the election, concerns about what's happening in other parts of the world, notably in Israel. So we've been actually surprised at how far and how fast this market has run. And we've started to take profits against that market run.
What pockets of the market right now, Lori, are you finding most attractive?
Yeah. Well, the first thing is we still are roughly neutral to slightly overweight equities. So while we've pared back our overweight position quite a lot, we still are slightly overweight, and we still do like large cap US. But the important thing is that we do see a broadening out of the market. So trying to take advantage of other parts like industrials, banking, other kind of cyclical sectors that perhaps were a bit left out of this rally that might have room to run from here.
You know, you mentioned how you're taking a bit of profits, and of course, Romain talked about LVMH and the waning Chinese consumer. That, of course, all came out before China announced all these different measures to boost its economy. Do you think that's going to have a lasting effect on sentiment for global stocks?
We actually don't, and we're already seeing that China trade roll over even as we speak. And part of it is that there's just not been a lot of detail about specifically what kind of measures they're going to take. And oh, by the way, the size of the stimulus that they're talking about pales in comparison to what they've been able to deploy in past market cycles. So we actually don't think that there's going to be a lot of benefit as you look more broadly across the globe from any kind of China stimulus package.
And this is something that we're going to hear from multinationals throughout this earnings season as well. What's going to be the source of strength for companies when they do report earnings?
Well, there'll be a couple of things that we'll be looking for. And as you know, it'll be pretty idiosyncratic. Even within industries, those who have kind of cost leadership are going to be in a better position than those that perhaps are a little bit more price takers on the input side. So we'll be looking at things like labor costs. How are those evolving through time? We'll be looking at things like, where are they seeing pockets of weakness or strength? We continue to like companies that have quality, that have strong balance sheets, that have competitive moats, and that are in sectors that are actually growing.
Is there any concern here, though, about some of the dynamics, particularly the dynamics going on outside the U.S. and its effect on the U.S.? Mike Wilson of Morgan Stanley this morning talking about the strength of the dollar, which is, of course, tied to the rate picture or the rate differential picture, and saying that could actually be, at least in his mind, one of the things that upends this rally.
Well, actually, one of the reasons why we've continued to favor U.S. large cap stocks in particular is because of that dollar strength. So you think about buying assets outside the U.S. and against that dollar strength, you're actually losing when you translate those, those currency translations. So we actually, in part, do like the U.S. because of the strength of the dollar. But it's hard to disaggregate right now what is really a kind of safety trade or a quality trade, which versus what's fundamental. So one would envisage that as the Fed sort of gets pace with other central policymakers, those interest rate differentials will be less a driver of the dollar, but there's still that flight to quality trade that you can't ignore.
I'm curious, when you look at the market today, Lori, and you go back over the years of your career, even in the early days here, are there any real parallels that you found, or are we kind of in completely uncharted waters? Because I feel like everyone's trying to sort of find that historical connection, and no one really seems to be able to give me that historical connection.
Well, we always say, history may not repeat, but it certainly does rhyme. And we've been in tightening cycles before, and we know that in tightening cycles, equities tend to run for a while, even after that first tightening, because you have momentum in the economy. And similarly, we've been in easing cycles before, and similarly, you see that in easing cycles, as long as there's no sort of undercurrent that we're going into a recessionary environment, that can be a reasonably good place for investors to be in equities as well. But what we do feel like right here and right now is that having a lot more diversification really matters, because trying to find specifically which pockets are going to outperform is going to be really, really tough, especially against a policy backdrop that's evolving.
So speaking of momentum, do you see any momentum in the oil market? Because it's being whipsawed by geopolitical developments. And of course, the undercurrent through all of this is that there's a lot of supply and demand, especially from China, isn't really shaping up to what a lot of people had expected.
Yeah, we were a little bit surprised that equity or that oil was getting such a bid because we just didn't see it in terms of the organic demand. And you have a lot of little calibrators. I mean, obviously you have what's going on in the Middle East, but you also have the ability of the U.S. to be an incremental source of supply in oil. So we were actually a little surprised when we saw the run up. So seeing oil correct a little bit here doesn't surprise us at all. We think it's going to be a pretty volatile trade just because of the geopolitical dynamics that underpin it in this moment, though.
We started with earnings. I want to come back to earnings. Will oil play a spoiler role in the third quarter results and the outlooks?
Well, look, the good news here is that energy companies have actually trailed across the market this year. So there is sort of room for upside there. And again, given that we're likely to have a soft landing here in the U.S. and that the broader market globally is sort of muddling through, there will be demand. And so then the question is really, what's the cost structure? And again, that's where I think you'll see a lot of differentiation across the different earnings announcements.